House prices are predicted to fall up to 30%. Let's have a look. Hello everyone, Florian.Heise here and welcome to another episode of HeiseSays. I've got my stein of coffee still serving me well, and I thought we'd have a look at this article from the ABC discussing the concerning trend in auction clearance rates and that house prices could fall by 30% in a worst case scenario. So there you go guys, this is starting to appear in MSM, mainstream media, predictions of big falls. Now, I'm not a fan of auction clearance rates. If you visit my website, the blog, you can see there's an article that, thanks to information provided by Fresh Canvas, that the auction clearance rates are inherently incorrect. They're biased to the positive, to the better result, because they ignore people who don't give a response, essentially. And real estate agents, being the gregarious people person we all know and love, don't like to kind of share when they fail. That's why the house across the road from my place has been sitting with a for sale sign for weeks now. For weeks. After it passed in an auction and no one knew about it. It wasn't reported that it passed in. No one even turned up. There you go. It still hasn't moved. Apparently, I'm told by the neighbors, because that's how the rumor mill works, they don't want to sell for less than they bought it for. There you go. Hate to really need to, flip the property quick to get some emergency cash. Well, that's where you get bargains, isn't it, everyone? So let's have a look at this article from the ABC. Predictions house prices could fall by 30% in worst case scenario as the illness restrictions bite. And this 30%, where do you think it's going to be? Do you think it's going to be uniform? I'd bet a carton that the majority of it will be, or the falls we're going to see will be in Sydney and Melbourne, just because of how much higher they are. One property analyst warns the worst case scenario, where coronavirus restrictions are extended for at least 6 months, could see house prices tumble by up to 30%. Now here's the thing. We're hearing everything in news in every article going, first home buyers, get in now, FOMO, FOMO, FOMO. And FOMO is fear of missing out. It's to create a psychological desire for your irrational purchasing need. But if people are expecting property to fall by 30% or even by 10% or even by 5% for something that could amount to years of your mortgage, people will wait if they can. And what happens when everyone starts waiting? Money printer goes brr. Louis Christopher, the founder of SQM Research, has told the business house prices will fall regardless of when restrictions are lifted from here. But the time frame will have a major impact on the depth of the property price downturn. Mr. Christopher says a V-shaped recovery, where dwelling prices fall in the June quarter but start to rise again in the September or December quarters, could still occur if the illness cases continue to fall and restrictions are gradually lifted during May. Here we have another person hoping for a V-shaped recovery. I think this is going to be more like what happened during the Great Depression. I think it'll be dragged out a little bit, guys. I think we're going to see the ramifications of this for a few years. The impact of foreign trade and demand for natural resources is going to hit our economy. Anyway, however, if a second wave of the virus occurs and restrictions were prolonged, he expects a major fall in housing prices. When I say major, we're talking up to 30% decline over a 12-month period, with the bulk of those declines occurring in Sydney and Melbourne, he said. We're not saying this is definitely going to happen. It's more of a warning that if we were to see the restrictions with us for a full 6 months at the current levels, this is what would happen. Fall in migration to hit Sydney and Melbourne markets. I'll bring up this chart, everyone. This is showing building approvals from foreign investors. So look at that black line. It was nearly 100% between 14-15 and 16-17. You think that may have had an effect on housing prices here in Australia? Mr. Christopher said Sydney and Melbourne will bear the brunt of the downturn, as they are the most overvalued housing markets in the country and are much more reliant on net overseas migration than other capitals. CommBank economists are also forecasting the Sydney and Melbourne markets to be hardest hit due to their reliance on population growth and the nature of their economies. The New South Wales and Victorian economies have more exposure to the most heavily impacted service sectors and less exposure to the more insulated sectors like mining and agriculture, CBA senior economist Gerard Arid said. But what about mining, mate? We've seen what's happened with oil prices, how it can just go crazy. What's going to happen with iron ore demand over the next few years? Is it going to be the same? Maybe China will just go nuts and just stimulate out the wazoo, building and building, and it could prop up our iron ore sector. In a recent note, CBA put the estimated decline in capital city prices at 10% over the next 6 months, or 20% on an annual basis, with similar forecasts from other economists. However, Mr. Arid noted the forecasting is incredibly challenging right now, given the unknown length of the restrictions. One thing with all of these property prices, I saw a tweet shared by Nugget News. The hedonic index, if there's not enough information, not enough daily trades, they won't be able to do it anymore, so they'll have to stop it. What do you reckon, everyone? Does that turn it into propaganda? If it's suddenly falling the other way? Regardless of which scenario plays out, Lewis Christopher says the rental markets in the nation's biggest capitals will take a big hit. We're going to see a significant rise in rental vacancies and a fall in rents. Well, particularly when you can't kick people out anymore and people are going on hashtag rent strike. SQM Research's weekly data on asking rents has already recorded a 5% fall in rents in Sydney and a 2% fall in Melbourne. With new dwelling being built to keep up with population growth each year, Mr. Christopher says, the drop in net migration, as well as short-term holiday rentals being transferred to the residential market, will see a surplus of around 100,000 dwellings for rent. Well, there you go. There you go, guys. We saw that with all of the Airbnbs getting flipped over, particularly in Tasmania and Melbourne. 100,000. Now's the time to shop around for good deals on your rent. That should translate into a doubling of rental vacancies across the country, which will be great for tenants but won't be so good for landlords. Mr. Arid expects falling rents to feed through to falling prices, while noting that current policy changes at the state level, changing rules around evictions due to rental arrears during the illness crisis, will act as a major deterrent to some would-be landlords investing in property over the next 6 months. Do you think it'll just be the 6 months? Or do you think people will look at other opportunities? So true test once mortgage holiday ends. Yes, that's it. That's a great point. When everyone's, everyone's touchy-feely, happy, lovely, RBA, the banks are so nice to us, they're cushioning the blow, and everyone's getting 6 months off. What happens? What happens when our arrears start kicking in? When the banks start pressuring people to sell, guys? As job losses, stand-downs, and subsequent drop in income amounts, and the Reserve Bank governor warns of the worst economic contraction since the 30s, Eliza Owen from CoreLogic says it seems hard to digest how property prices are yet to tank. Because it's all been buffered yet. We haven't really experienced it yet. People aren't getting desperate. Such extreme contractions in the economy could exacerbate the structural risk of high housing debt in Australia, Ms. Owens, CoreLogic Head of Research for Australia, said. At December 2019, the housing debt-to-income ratio rebounded to its record high of 142.1%. To date, the price falls are yet to materialise, but growth has slowed. CoreLogic's Daily Dwelling Values Index put the change in dwelling values at 0.4% over the past 4 weeks. However, Lewis Christopher said the leading indicators are pointing to an imminent decline. Over the past few weeks, auction clearance rates have plummeted. They were at the start of the year averaging between 65 to 75%, he said. Last week, auction clearance rates fell to 30.2% across the capital cities, the lowest on CoreLogic's records. And you have to remember, guys, that's biased to the positive. So I bet you carbon it's actually going to be worse than that. Ms. Owens expects the mortgage repayment holidays offered by the major banks are delaying the onset of the price declines, as the very low volume of properties being listed for sales. Yes. So here we go. If you're waiting, you're hearing, okay, I've read this is looking at 30% decline. Let's just wait, for the JobKeeper to end. I'll wait a good 6 months. Let's wait until these banks, nice touchy-feely periods are over, where they're no longer delaying payments. Let's wait for that. If you're a buyer, what'll happen? So demand will pull back. People will. I wouldn't be going for it now. I'd be waiting. What would you do? FOMO. Property always goes up. Over the 4 weeks to April 19, CoreLogic found a 28.7% decline in new listings compared to a year ago, while total listings of housing stock were down 23.8%. Here we go. Rolling 28-day counts in new listings. Boom. Certainly history we're living through, isn't it, guys? The only people listing their property in the current climate may be those who need to sell because paying off a mortgage is no longer affordable. But the number of people in this situation is minimized by a break in mortgage repayments, she said. Financial regulators, the RBA, and the banking sector may extend reprieve for mortgage repayments in the scenario that the economy has not made improvements within 6 months. So you reckon how long can they just kick the can down the road? Well, I guess if the RBA continues to provide liquidity for the banks, could they just keep doing it forever until inflation kicks in? Lewis Christopher agrees an extension of mortgage relief is likely if the downturn drags on. I think the banks will want to avoid a mass repossession event. Yes, because it's their assets. The houses are their assets. And we don't have fractional reserve banking. It's tied to the assets that the bank has control over, a certain share of them. So if they all plunge in value, it's going to be interesting times. So it's our view throughout this crisis that we're unlikely to see many forced sales unless we were to see a major extended economic downturn that lasts, say, 12 to 24 months. Then the banks may have to move towards repossession, he said. And this is the thing, one of the advantages of Australia is that you can't just send jingle mail back. You can't chuck the keys and give the house back to the bank and make it their problem. People are stuck with it. So there you go, guys. Predictions of a 30% fall in houses. Worst case. What do you think? Are you rushing out to buy now to make sure to lose 30%? As always, like, share, subscribe, and leave your comments down below. If you're a fan of the channel and you want to support us, you can support us by joining the channel on YouTube or on Patreon, using our affiliate links at Amazon or eBay, using our referral links at Independent Reserve or Kucoin for the crypto traders out there, buying our merch from Teespring or the HeiseSays blog. You can see Rachel's pocket squares behind me. You can send us gold via Gold Pass from Perth Mint, and you could also support us via PayPal. Thanks everyone, take care, and I will see you in the next video. Bye for now.